As the world is dealing with the Russian invasion, as well as hiked rates by the Federal Reserve, longtime Tesla bull Cathie Wood anticipates what she claims to be an imminent market crash. Given the current state of affairs, this might bring on panic to many investors, but never fear. Why does Cathie Wood say that a big market crash is coming? Has this happened before? What is the best way to handle the market crash when it comes? Keep watching to find out. Financial markets were in the midst of one of the wildest anything-goes periods in history only a few months ago. Today, though, the atmosphere is different. Between high inflation and higher rates, a stock market crash could likely be in view. Cathie Wood, CEO of ARK Invest and financial expert, raised some concerns about a possible recession in the United States and a significant slowdown in China in her firm's quarterly report released recently. In her letter to investors, Wood wrote, "During the next 3 to 6 months, the market is likely to focus more on the risk of recession in the United States, a serious slowdown in the Chinese and emerging market economies, and potentially a surprising drop in inflation." Why does Cathie Wood believe there will be a market crash? There are several risk factors that we believe will put the market in a precarious position. As Wood mentioned, there's the issue of the Chinese economic slowdown. While the United States faces numerous short-term economic challenges at home, experts advise investors to keep an eye on China. In 2022, the Federal Reserve of the United States is expected to hike interest rates and sell assets, whereas China just lowered rates and pumped liquidity into its banking system to counteract sluggish economic growth. China's economic growth is expected to decline from the initial 8.1% in 2021 to barely 5.5% in 2022. China's stock market has also suffered as a result of the country's crackdown on domestic tech businesses. Finally, the International Monetary Fund has expressed concern that China's stringent zero-COVID strategy is having a negative impact on the country's economy. There's no doubt that the stock market has had a rough start to the year, and many on Wall Street are expecting it to get considerably worse. With tensions rising due to pending and occurring geopolitical events, this hardly comes as a surprise. According to DataTrek Research co-founder Nicholas Colas, unexpected geopolitical developments are always a danger for investors. Although geopolitical developments are difficult to forecast, there are a number of reasons for investors to be concerned. Russia's invasion of Ukraine resulted in President Joe Biden issuing U.S. sanctions on Russia. North Korea is also said to be considering restarting nuclear and long-range ballistic missile tests. Also, growing tensions between China and Taiwan could jeopardize global supply networks. Despite a strong rally in the final days of January, the MSCI World Index of global stocks dropped by more than 6% in the past months, marking the worst start to a year since 2008. This equates to a $6 trillion loss in value. With investors expecting the Federal Reserve to raise interest rates aggressively this year, the stock market looks poised to respond harshly if earnings growth falls short of the market expectations, especially after Facebook stunned investors with dismal results. The U.S. technology stocks that spearheaded the post-financial crisis boom have extended their decline in 2022 to about 10%. The fundamental source of market anxiety is self-evident. Many central banks have felt driven by increasing inflation to tighten their policies after nearly 2 years of vigorous support to mitigate the economic impact of the COVID-19 outbreak. Bond buying programs worth trillions of dollars are being phased out, and interest rates are set to rise. The Bank of England became the first major central bank to boost rates in December and followed with a second increase this week. It's expected to be followed by a slew of other central banks in the following months, with European Central Bank hinting on Thursday that rates could be raised in 2022. We understand that to combat inflation, the Federal Reserve Board will have to raise interest rates. This is likely to hinder economic growth and increase unemployment. Perhaps the Federal Reserve will get it just right and the economy will cool without pausing. Or perhaps the worst will happen and the economy will enter a protracted recession. Wood's advice? Invest in innovative and disruptive stocks. A recession, according to Wood, means that creative tech equities, such as those on which her firm has placed their large bets, might fall into deep value territory during the next 5 years. She says adoption of new technologies typically accelerates during slowdown as concerned businesses and consumers are more willing to change their behavior patterns. The coronavirus crisis transformed the world significantly and permanently, suggesting that innovation-driven stocks could be productive holdings during the next 5 to 10 years. Wood became a symbol for the bull market that began in late March 2020, when central banks began sprinkling money into markets to prevent the economic calamity caused by COVID-induced lockdowns from becoming a financial crisis. Wood's Florida-based ARK Invest made large bets on disruptive technologies ranging from electric automobiles to cryptocurrency through a series of actively managed exchange-traded funds. Volatility isn't always a bad thing, she told tens of thousands of ARK investors who tuned in to watch the interview. I've never seen innovation on the market like it is now. Her views come as the ARK Innovation ETF, ARK Invest's flagship product, has already lost approximately 20% this year. This comes after a 24% decrease in 2021, following a star-studded 2020 when the fund soared more than 15%. However, after months of withdrawals, the fortunes of the ARK Innovation ETF turned around in February, with $411.3 million in inflows into ARK Invest's flagship fund. Cathie Wood told CNBC's Capital Connection earlier this year that the firm has experienced substantial inflows. ARK is an actively managed exchange-traded fund that invests at least 65% of its assets in firms that are relevant to the disruptive innovation investment theme. According to ARK, disruptive innovation is the introduction of a technologically enabled new product or service that has the potential to revolutionize the way the world works. This category includes businesses that rely on or benefit from the development of new products or services, technological advancements, and scientific research in the areas of DNA technologies and the genomic revolution. According to the website, the flagship fund's top assets include electric vehicle manufacturer Tesla, video communications platform Zoom, virtual healthcare startup Teladoc, TV streamer Roku, and cryptocurrency exchange Coinbase. Despite sharp drops in high-growth firms like Zoom and Teladoc over the last year, Wood previously stated that the stocks currently represent a value as the company's sales and profitability improve. Given our predictions for growth in these new technologies, I believe we'll see some phenomenal returns. Others have also warned about the possibility of a market correction. Jim Paulson, chief investment strategist at the Luthold Group, an independent investment research firm, said, "The intraday swings have been breathtaking. Some key segments are now in a bear market. Who knows how much longer the devastation associated with the roller coaster ride will last, or where the stock market will eventually bottom." Christina Hooper, the chief global market strategist at Invesco, a firm with $1.5 trillion in assets under management, believes the probabilities are increasing because it has been so long since the last correction. The U.S. Federal Reserve's efforts to decrease its balance sheet and increase interest rates have only added to the odds. Michael Strobeck, Credit Suisse's global chief investment officer, agrees with Wood that there will be a crash. He stated that we're in the midst of an interest rate hike cycle, which means headwinds for markets, particularly stock markets. The current market climate is not the buy-the-dip atmosphere that existed before the Federal Reserve went all in. Jeremy Grantham, a well-known investor who has long warned about the fourth super bubble of the previous century, recently warned that the recent drop in highly speculative equities could just be a foreshadowing of a far larger, more painful catastrophe that could occur at any time. However, Wood is not alone in thinking investors stand to benefit in the current circumstances. After Netflix posted disappointing quarterly results last month, hedge fund manager Bill Ackman revealed that he had crashed in a $1.25 billion windfall from speculating on interest rate rises and put the money into the streaming giant. In a letter to investors, Ackman stated that many of our best investments have appeared when other investors with short-term time perspectives trash terrific firms at values that look astonishingly appealing when one has a long-term horizon. Investors are tense as we're currently experiencing high inflation, but this technically means that the market is booming. However, if the Federal Reserve effects a market correction that's inefficient, this could in fact lead to a market crash. Experts seem to be on the fence as to whether this could be of advantage to investors or not. But one thing is clear, the majority of them agree with Cathie Wood that a market crash is looming. Do you foresee a stock market crash as well? Do you agree with Cathie Wood in her reasoning that this could be an opportunity for investors? Comment down below.